Now, the whole purpose of charting the price of a market is to identify trends at the early stages of development for the purpose of trading in the direction of those trends. Now, the concept of trend is absolutely essential to the technical approach. Here again, unless one accepts the premise that markets do in fact trend, there's no point in going any further. The whole purpose of charting the price action of a market is to identify trends in the early stages of their development for the purpose for the purpose of trading in the direction of those trends. In fact, most of the techniques used in this approach are trend following in nature, meaning that their intent is to identify and follow existing trends. There is a corollary to the premise that prices move in trends. A trend in motion is more likely to continue than to reverse. This corollary is of course an adaptation of Newton's first law of motion. Another way is to state that trends in motion will continue in the same direction until it reverses. This is another one of those technical claims that seems almost circular or perhaps familiar, but the entire trend following approach is predicated on riding an existing trend until it shows signs of reversing. So in a sense, to paraphrase that, the trend following approach, you continue to ride a trend until there are signs of that trend reversing. Then we look at the last one, which is history repeats itself. The key to understanding the future lies in the past, lies in a study of the past, or that the future is a repetition of the past. Much of the body of technical analysis and the study of market action has to do with the study of human psychology. Chart patterns, for example, which have been identified and categorized over the past 100 years, reflect certain pictures that appear on price charts. These pictures reveal bullish or bearish psychology of the market. Since these patterns have worked well in the past, it is assumed that they will continue to work well into the future. They are based on the study of human psychology, which tends not to change. Another way of saying this last premise, that history repeats itself, is that the key to understanding the future lies in a study of the past, and the future is just a repetition of the past. Now, those are the three main elements that support the chart-based approach. Market action discounts everything, prices move in trends, and history repeats itself. There is another side of this argument, and that side of the argument is the fundamentalist approach, which is really studying the fundamentals in the market, which we can look at in a future lecture. But we will stop this tutorial here, and we will continue in the next tutorial. Well, before we go to the next tutorial, I may just at this point lay some of the arguments between the technical versus fundamental methods. While the technical analysis concentrates on the study of the market action, fundamental analysis focuses on the economic forces of the supply and demand that causes the price to move higher, lower, or stay the same. Fundamental approach examines all the relevant factors affecting the market or affecting the price of a market in order to determine the intrinsic value of that market. This value is what the fundamentals indicate something is actually worth based on the law of supply and demand. Now, both the approaches to the market attempt to solve the same problem, that is to determine the direction of prices are likely to move. They just approach the problem from different directions. The fundamentalist studies the course of market movement, while the technician studies the effect. The technician, of course, believes that the effect is all that he or she wants to know, and that the reasons or the causes are unnecessary. The fundamentalist always has to know why. Most traders classify themselves as either technicians or fundamentalists. In reality, there's a lot of overlap. Many fundamentalists have working knowledge of the basic tenets of charting analysis. At the same time, many technicians have at least a passing awareness of fundamentals. The problem is that the charts and the fundamentals are often in conflict with each other, usually at the beginning of important market moves. The fundamentals may not explain or support what the market seems to be doing. At these critical times in the trend, that these two approaches seem to differ the most. Usually they come back into sync at some point, but often, maybe, too late for the trader to act. So, those are the two basic tenets: fundamentals and looking at charts. Whilst most people will classify themselves as one or the other, in reality, the two of them do overlap. I think that the charts, the market action is discounted. Market action discounts everything. Yes, I believe price moves in trends. Yes, I believe history repeats itself. Yes, and I also believe that news does affect the market. But what we'll be looking at in these next few tutorials is the charts themselves, and how to read those particular charts. So finally, we will stop this tutorial at this particular point, and we'll continue at the next lecture. See you then.